Well, good afternoon, everyone. So it looks like we have an easy session just after lunch, trying to keep everyone engaged. Delighted to be here. So just jumping in immediately. So infrastructure today is no longer just roads and bridges. It's the power systems, the digital backbone that enables AI, clouds, and high growth industries. Investors are rotating capital into these assets for resilient cash flows and inflation linkage. But there's a challenge. Underwriting is getting more complex. Structures are getting more challenging. So over the next session, we'll decode where the bankability bottlenecks really are, how partnerships can scale capital efficiency, and how regional mandates are evolving across this region as well as comparable regions. So, and then we'll try to close with clear, actionable takeaways for investors that they can move on in the next quarter. So Hanan has kindly introduced our three leaders, and we'll engage quickly with them and see how we can deploy and structure capital across the regions. So let's just see what really works, what's bankable now, what's next, and how investors should do in Q1. I'll start with you, David. So let's just start with the fundamentals. Where are the bankability bottlenecks showing up in today's deals?
Yeah, thanks very much, and great to be here. I mean, certainly our experience, we're an Asian-based private credit manager, but we have been in the region for 28 years, and a lot of our business is now expanding out to the Gulf region. And I think, with banks in terms of deposit holding institutions, typically we find that they're there once some of these projects are up and running, the cash flows are there, and they have been proven to be viable. And I think where private credit steps in is through being able to come up with heavily structured instruments that enable entrepreneurs, business owners, the ability to use our money to get those projects to the bankability stage. That's certainly been our experience.
And do you still see the same focus on structures? Typically infrastructure projects have been heavily structured, or is it more about just due diligencing and finding the right bespoke partnership? Someone on the previous panel mentioned being in an industry where there's a barrier to entry.
Yeah, look, it's multifaceted. Obviously, if a project can stand up on its own fundamentals, that's the ultimate proof in the pudding. But inevitably, in particular, say with energy transition, there needs to be a little bit more of a catalytic role in getting private capital to bank these types of projects. So at the fund level, we work with government-backed entities that are very much focused on this energy transition story, and they can provide a first loss or a guarantee to the fund that then enables more, say financially motivated capital to come in to pick up the residual amount of that fund. Then at the project level, like fixed price PPAs, which enable us as a lender to be able to take out some of the variability of the underwriting process, definitely helps. That said, you still need to look through, and if something goes wrong, what's the reality of the counterparty to pay you back? So It's multifaceted, but ultimately you want to be banking projects that can stand on their own 2 feet, and then the capital comes.
Okay. Well, we'll come later on to those partnerships with blended finance providers in particular. So Edouard, drawing on Allianz GI's private markets approach with the infrastructure asset class, where are the biggest bottlenecks and how is private credit addressing some of these risks?
Yeah. So number one, thank you, Mohamed, for moderating, and also thanks for Emma for putting such a great agenda this afternoon. Maybe as way of background, just on our AGI private market platform and how we've been investing in infrastructure for almost 30 years. So we are a 120 billion private market platform, 50% of which is investing in infrastructure, both equity and debt, primarily into Europe, but more and more globally. So we created this program on the back of Allianz balance sheet, willing to match their long-term liabilities with the right level of assets and the right type of assets on the asset side in terms of matching the cash flows with the liability stream. So that's the genesis of what we've been doing. And over the years, we diversified away from Europe into LATAM, into the US, and now also into Africa and the MENA region, as well as into Asia. So that's the platform as it stands today. Going back to your question, what does that mean in terms of bottlenecks? We are insurance by nature, so we are looking at the downside risks. But more and more, the way we look at structuring deals is about what type of inputs is important in order to structure those deals. One is, if you expand away from certain jurisdictions, is obviously regulatory regimes. So that is very important. We do the right level of due diligence. More and more we are programming and applying certain CapEx allowances. And we also pass on some of these risks to commercial structures like pass-through vehicles or requiring minimum customer contracts into the deals. So that's on the regulatory front. When it comes to ESG considerations, if you invest in the region, for instance, the access to green power is going to be very important as you invest into data centers, for instance, but also a consideration around cooling and what happens with wasted water. So all of this flows into how you structure, how you price the deal. So more than bottlenecks, we see that as design inputs that you need to program and you need to plan for the long term.
Thank you, Edouard. Thomas, data center is really the bread and butter of what you do in terms of structuring and building these projects from the bottom up. How do you see the tension between supply chain, energy, power costs, and energy transition strategy and requirements, which Edouard mentioned? Thomas, how do you see this being managed in the context of high pressure, quick to market projects?
Yeah, thank you, Mohamed. That's a great question, actually. So let me maybe take a step back. We are convinced that the world is going to be driven by capex-led growth instead of consumer-led growth going forward. So capex means high risk of misallocation of capital. Those capex should be concentrated on what McKinsey called the 4Ds, so decarbonation, digitalization, defense, deglobalization. And of course, I mean, building the right asset at the right place at the right time is not, is something which is very difficult to do. So that's why somebody like Warren Buffett says that when there is a lot of capex in a sector, you need to either avoid the sector or be extremely selective. So first of all, there is an opportunity, but there is also a big risk of misallocation of capital, hence your question. Now, with regards to digital infrastructure, there is obviously a huge capex need. Next year, probably $500 billion will be spent there, growing at 20% CAGR, so $800 billion in 3 years, which is kind of the equivalent of the US defense budget, so it's a lot of money. A couple of the pools of financing are now getting more structured. So hyperscalers have access to both the bond market and the private credit to finance their spending. There is still a lot of leeway, despite the fact that this year there's been massive issuance of bonds. According to Goldman Sachs, in order for those hyperscalers to reach one-time EBITDA, they can still issue like 700 billion of debt, so there is still a lot to do. Then you have banks financing between 4 and 8% projects that are de-risked, so where there is no commercial risk taken. And then in between there is space for private credit, probably. The private credit is only explaining 5% of the specialty finance, so it's a 5.5 trillion market. Specialty finance needs at the moment, so there is still a lot of space to grow, and we think that there is a sweet spot here to finance data centers in good locations that have secured their building permits, secured their access to power, but by taking construction risk and commercialization risk, you can finance at double-digit return. And there, probably there is space for private credit.
Okay, so maybe staying with you in terms of how the scaling of these projects and the meeting the demands of this big pipeline. I mean, not all data centers have a guaranteed 30-year cash flow with Google or Microsoft. So are you seeing kind of these different templates for different participants or market participants?
Yeah, first, I mean, there is supply. When you, I mean, 70% of data centers currently are built in the US. So if there is a risk of oversupply, it's probably there. I'm not saying that there is one, but you know, for example, in Europe, Europe is trying to catch up with that, and so the risk of I would say oversupply in Europe for now is contained. Now, of course, as you said, I mean, not all projects are equal. For us, there are three things that are very important to in our selectivity. The first one is location. I mean, we also manage 15 billion euros of real estate, and our motto is, you know, location, location, location. You can buy good assets in good location or develop good assets in good location, and then you know it's kind of core real estate. You can buy bad assets in good location and transform them, and it's value add, but never buy or develop assets in bad locations. Two is probably the credit quality of the end user, and you're right. I mean, when it's Google or Amazon, that's probably fine, but it's not always the case. So you need to be very careful about that. And then you have the time to power. Time to power is very important because, you know, of course there is this industry puts a lot of pressure on the grid. So securing access to power is one thing, but you know, time to power is another one. So you need to be extremely selective on that.
Okay, no, thanks, helpful. Edouard, earlier, just talking about kind of this ability to scale to meet the demand, you mentioned blended finance or involving different participants and building on how these partnerships can be structured. So it'd be helpful to get your perspective on how the role you can see blended finance as one of the major sources of finance and the tools and instruments that are being deployed on some of the deals that you're investing in.
Yeah, so I'm happy to bring a bit of a context of how we see investment partnerships with institutions, sovereign wealth funds, and other institutions on the pension side. Because at the end of the day, when you invest in infrastructure, you want to have alignment of interests of how you invest and also what you invest in, right? So some of the organizations think about investing in the future economic models that will drive future performance into their portfolios, and how they invest is about having alignment of interest, but also how we structure those transactions. So when it comes to regulatory and licensing considerations, so yes, you need to look into the specifics country by country. But to your question, indeed, if you go to lower rated jurisdictions, investing alongside DFIs, for instance, via participation loans, allows to share the risks. And in that respect, in particular for pension funds who are looking at a more senior part of the transaction, that will allow for them to participate into certain jurisdictions. So that is one aspect. What we also see is with large scale organization, pension funds, sovereign wealth funds, and others, they are looking into SMAs, very particular bespoke co-investment sleeve, for instance, or Sharia compliant structures. And in that respect, that increases the demand for very specific guidelines, for very specific criteria to invest. And last but not least, on the ESG side, and you talked about particular countries, Africa or emerging markets, and then indeed requirements for environmental and social considerations are going to be even higher, KYC, AML considerations. And so here, it is all about how you structure those partnerships with the right level of risk return, but also understanding that over the life cycle of these investments, you need to provide transparency on ESG, on certain risk, but also in terms of reporting, you need to be at the forefront of this.
Thank you, Ed. I think, David, when we were preparing this session, you told me you're passionate about the challenges of ESG and the reporting, and also you operate in a variety of markets across Asia. So it'd be helpful to draw on that experience as to how you allocate some of these risks, whether sovereign-related risks or ESG requirements, and whether there are some major showstoppers for investors or lenders from your point of view.
Yeah, I'd say generally speaking, our experience has been that when you're looking to finance these projects, you are able to pass a lot of the, say, obligations onto the borrower. There's not a sort of a deep pool of other options for these borrowers, and political events, change in business plans, things like that. Typically in our loan agreements, we would say, that is the borrower's responsibility and it would trigger an event of default. So, wash your hands, job done. But in reality, when these events happen, that's when managers with experience need to roll up their sleeves, get their hands dirty, really understand how, well, first of all, to preserve the money that you're managing, make sure that you can not lose value, and two, start suggesting ideas, exploring different options to pivot these businesses, to turn them around, and ultimately create a liquidity event to get your money back. In terms of ESG, that's a core part of our business. We believe we have a fiduciary responsibility to take those factors into consideration when underwriting our loans. It's prudent from a risk management perspective. There seems to be more and more environmental disasters and social issues happening. And we think and have experienced that if you address these issues, then you've done a good job in protecting your investors' money. Now the key here as well is if you can create that win-win scenario, so where the borrower also gets the benefit to their bottom line. And we've got numerous examples of that as well, which is, it's when you're really onto something good. So you're not just managing it from a risk perspective, but you're adding value and creating options for the borrowers that you lend to.
Thanks, David. So let's just zoom out and see how you see some of the regional trends, opportunities, also some of the lessons learned from your other markets, the potentially reshaping the opportunity here for investors. So just David, staying with you, I understand a number of your Asian borrowers are looking to expand into the MENA region. Can you talk about some of the prerequisites for these businesses to be successful in their expansion?
Yeah, I think the growth in the region here is super exciting. We're all here. We all buy into that. And a lot of the borrowers that we have in Asia are now seeing this potential and are exploring their options out here. A couple of examples: a Chinese-based school which is looking to come over here and address the ever-growing Chinese expatriate community that's building here. Those parents and their kids will ultimately want to be able to go back home and send their kids into a schooling system that's, or you have their kids at a schooling system here that's aligned with the national project in China. We've also got interest in an Australian-based organic silicon fertilizer business, which is one or a couple of its largest customers are based in this region, and also geographically it makes sense to expand production and distribution from this region as well. So the region is pro-business, so that's super positive. The governments are doing a lot to help provide the infrastructure that's needed for these corporates to move out here.
And in terms of structuring these projects, having kind of a local, in terms of the equity of these projects, are you relying on the expertise of these borrowers, or do you see partnering with governments or partnering with sovereign wealth funds as being key for the success of these projects?
Yeah, look, it's not dissimilar to what we saw in Asia or see in Asia, where you're quite naive if you think you can go and build a school in a foreign country where you don't have much knowledge or know-how. So definitely partnering with locals, experts here is critical to the success of these projects that are coming out. Yeah.
Great, thanks, David. Edouard, just moving to you in terms of kind of the region's ambitions. I'd like to draw on your global insights around across geographies and what you see also across infrastructure assets. Do you still see a big focus on mitigants, highly structured projects, escrow waterfalls, offshore holdcos, jurisdiction for dispute resolution mechanisms, political risk cover? Are these still kind of key components of it, or do you think people are starting to try to be a bit more nimble in terms of how they structure those projects?
So, being interviewed by a lawyer, I knew we would be asked technical questions on structuring. And I talked earlier about design inputs for how we structure deals. Indeed, you need to think about what could go wrong, right? So because you work in multiple jurisdictions, you acquire capital offshore that you're going to be redeploying in different regions. And in that respect, thinking about the risk scenarios is critical on how you're going to structure those transactions. So there are a few things we look into. Number one, more from a structural point of view. So do you have, as an instance, offshore holdcos or offshore accounts that allow you to tap into certain pools of money if all of a sudden in this given jurisdictions you're going to have capital freeze or you're going to have capital retention, right? So this is one of the structure that we look into. And if you have, for instance, export-led projects, indeed pledging offshore receivables can be quite powerful on how you structure your deals. So that would be on the structural side. On the contractual side, we're going to be looking at international arbitration with recognition treaties, thinking about what could happen if there is a change of laws or certain sanctions that are imposed on a given country, right? So already from the outset, thinking about these type of events and making sure that you have covenants in place that will apply earlier on in those events before those projects default. So that's another aspect. And going to your earlier question about mitigants and also partnering with DFI, so MIGA policies or insurance, ECA guarantees, but also co-investing with DFIs who are going to be providing the first loss capital are another way of structure those deals when you invest in emerging markets.
It's fantastic to see kind of staying away from some of the exuberance that private capital have been kind of associated with, I guess, recently. So I think I guess in the infrastructure space, that kind of more boring approach I think is still kind of an important component. And less boring, I guess, is kind of data centers, and TKO has been really heavily involved in that space, Thomas, and a number of countries in the region have floated ambitious plans to deploy their own data centers that sometimes fueled by local requirements for data localization, and that's AI has poured fuel on that fire. So how do you see that macro trend implementation in the context of some other geographies which are less obvious than the 70% in the US, for example?
Look, I think this country here, the Emirates, have expressed very clearly their willingness to leading the way with regards to AI and digital infrastructure in the region. So we've opened an office a couple of years ago. We have investment teams on the ground. And so what we are trying to do right now in the region with regards to digital infrastructure is two things. First is transferring the expertise that we've built essentially in Europe here, and probably partnering with the local investors here to build a platform, because this is clearly a business where you need to be local. I mean, you need to be local in everything you do, but particularly in this business. So entertaining a couple of discussions around that, but also if you want to develop data centers and digital infrastructure, you need a supply chain. And so we also have a strong expertise on private equity decarbonation. We pioneered this business in 2018 by launching the first ever private equity fund dedicated to energy transition. In this fund, in those two funds, actually, we have companies that are a play on digital infrastructure. For example, one company is a German company called TTSP. It's an engineering company specialized in optimizing the use of water and electricity for data centers. They have a 50% market share in Germany. And so this is a company we could help to settle here, to be part of the supply chain. Same on maintenance of power cable. We own a company in Italy specialized in that. They've been involved in 6 of the 8 buildings of data centers of more than 10 megawatt in Italy, of which 3 for Microsoft. This company also could, and we will develop this company outside of Italy, and the region could be also an outcome. So I guess it's also make sure that the infrastructure is in place in terms of supply chain by bringing some of our portfolio companies to the region if there is interest from local investors.
So transferring human capital, knowledge, supply chain is essential. Now, looking at the future outlook, and it's kind of the theme, kind of the last theme we'll touch on. If you were to look at what most would accelerate, regulatory change or other change would accelerate private capital participation in data center projects and digital infrastructure, what would that be?
So look, first, I mean, I think there is a clear trend. If you look at private credit, so $2 trillion, a bit more than $2 trillion market right now, 43% of that comes from insurance flows. If you look at, so that's the AUM, in terms of flows, more than 50% of the growth of private credit today comes from the insurance business, and especially, long-term liabilities looking to be matched by private credit investments. So those players are looking for long-term stable cash flows, long-term stable investments, inflation protected. So there is a clear trend towards, I think...
So it's going to happen no matter what.
It's going to happen. Now,
Okay.
if you look at, in the US, there is something that doesn't exist elsewhere, and it's the securitization business. So securitization of data center financing, where those insurance companies can take, a senior sleeve of a securitization, helps a lot the flows, the capital flows in the US to finance this mega trend. In Europe, it's not the case yet.
I'm going to just ask Edouard to give his perspective. Do you see tokenization as being the future of the industry?
I think tokenization will be a tool indeed to allow for more liquidity and more participation of various investors. But if you ask me, let's join forces first around institutions. The opportunity to invest in infrastructure are gigantic. We need over $100 trillion of investment in the next 15 years to support economic growth. So it's all about joining forces between pension fund, insurance companies, sovereign wealth fund, DFIs. And yes, on the wealth side, we will see heightened participation. But in that respect, tokenization will be a tool. But for now, I think we're sticking to certain basics.
So running out of time, and I've been asked to give, just as a wrap up, to look at each of you as to one actionable takeaway for investors that they can implement going forward. David, let's start with you.
Yeah, look, I mean, the energy here in the room at this seminar is super infectious. It reminds me of sort of Hong Kong and Asia 30 years ago. And with the government being so pro-business, I can only hope that ADM Capital's part of this growth plan.
Okay, thanks. Edouard?
I'll keep it short. Let's join forces.
All right. Thomas?
No, I think routing capital towards the financing of resilience and sovereignty is in the interest of everybody, everywhere in the world. So let's make it happen.
All right. Thank you.
Thank you.
Please put your hands together for our panel members.